Yeah, go ahead.
All right, so we've talked about today, we're doing measuring, and there's ways to measure so many different things. It's unbelievable how the markets work. I mean, you can measure fair value gaps, you can measure order blocks, and then you take it down in fractally different time frames, and they become ranges and swings. So I've kind of, it's a very deep and dense topic, and we may even need a part two at some point. But I'm going to kind of go over some of the basics and give you some workable strategies you can use going forward. So let's just get to it. I'm going to the topics that I want to cover today. The halfway back is very similar to what Leopard does on a 50%, but really what it is gives you a very low-hanging fruit target, and it also teaches you certain strategies to use, when you're getting parabolic or moving up very fast. The Asian range is probably going to be the thing you guys who watch the streams or my streams are most familiar with. So I'm not going to say so much about that. Opening balance is very similar to the Asia range, but it's 9:30 to 10:30 versus 8 p.m. to midnight. And swing projections we can talk about. And then the final section is on grading of swings. And this is also a very, very dense subject. So I'm going to be scratching the surface on it. And there probably maybe another course going into that too. So let's get into the halfway back. For some of these topics, I wanted to put the settings fib picture up front so that anyone who wants can grab a screenshot of it, because I think that'll be very helpful to everybody. And really all that matters in this one is the 0.5 and negative 0.236. So the negative 0.236 is a target that gets hit very often. So it's kind of that low-hanging fruit target. Everyone thinks it's the first half deviation. It's not. And there's a lot of things around the negative 236 that'll help you measure it going forward. So what I'll do is I'll just introduce some examples. So here's the first one. This is on the 13th. This is about 9:30 a.m. Can you guys see my cursor while I'm moving it there? Leopard, you can see it? The pointer? I just want to make sure. Yes? Okay. So this is kind of the swing. It's at 9:30. It went into an FVG. It blasted up. We created an FVG here. We all know that it's 50%. It reacted. So what happens at 50%? Where do you target? Well, what you'll see is the first time it hit 50%, it all of a sudden went to this magical level and then reversed down. So what's this level? It's the 236. You always watch the 236. So if you had bought that first 50%, you probably would still be okay if you didn't sell here. It came back into the drawdown and then took off. But a good strategy is take it off here, because it might retrace, it might not. But if you see this kind of thing, then you can re-enter here. I mean, if you have a drawn liquidity much higher, that's a whole different story. But it's a very safe target, and you can do it on the 1 minute, you can do it on the 30-second, you can do it on the 5 minutes, very fractal. So there's two ways that the 236 gets hit, or the negative 23.6. It can get hit with a reversal, or it can trade to and through it. So I'll get to another example here. This is on the 14th. Another one. This is at 6 a.m. We kind of moved up, came down, reacted, but this time we didn't really stop at the. We didn't really reverse when we hit the 236. We kind of went right through it. So when you go right through the 236, and then you get the next retracement up here, there's a way to actually measure that, and I call that a fib extension. So you have I'm going to explain this. So you have the first retracement here, then you go right through the 236. When that happens, what you can do is you can draw from the high to this high, and here's the extension. So the first one we went like this. Second one we went up here, consolidate around here, and what do? Bang on that 236. So you can buy the extension, take it to the 236. And the reason the extension is valid is because, as I showed you in the last slide, we didn't stop. Like in the first slide, you see the 236 reacted and went down. This slide, we kind of went through the 236. We did consolidate around here a little bit, but that's where you can start getting into extensions. I'm going to show you another example on the daily. Oh no, this is the 15-minute. Oh, I showed you this one, right? Let me just make sure. Yeah, okay, see, that's it. So this is the daily. So here's another example on the daily. We started here, we went up here, hit the 50%, consolidate, and then just ripped through the 236. The daily is always going to have the best example. So what do you guys think would be a way to deal with that? Well, some people would say, we could draw from here to here, but really, because we've taken off, you could draw from here to here, which I did. And look at that, boom. right up into the 236. Reversed a little bit, but then took off again. So, we have another extension. So I would draw from here to here. And there you go again. Boom here into the 236. So that's the halfway back. I hope so. Basically, the takeaways from this section are when you have a 50% retracement, obviously you want to see confluences like fair value gaps, a Judas swing where we take liquidity and then a move up. The easy target is the negative 2.236, but if we sometimes whip through the 236, the 50% level when you're drawing from the high can be very sensitive. How do I know when to start drawing? Well, dealing range, right? So that's like any 50%. So if we go back up here, we're at 930, we broke the low. This is a very key time. We shot up, took the high, and then came back. This one too, around 9, it was a little bit later, but you see the expansion and comes down. Essentially, you have dealing ranges where you're taking a low and then a high. Let me just make sure we're going in the right direction here. Again here, like we took this high aggressively with a fair value gap, came back down to 50%, took off. So hopefully that makes sense. I mean, it's the same thing Leopard's showing us with his 50% and everybody else, like in terms of a 50% retracement. But with the halfway back, you want to see a very elevated and strong bounce, the 50%. If you see it like dithering and coming low and then coming up, it's not as relevant. But if you have a quick retracement to the 236 or through the 236, that is when you start seeing extensions. So you're going to do the extension when it rips through the 236. This didn't even, a lot of times what you'll have is it goes up here, comes to the halfway back, hits the 236, then does another halfway back, then goes. But when the market's really animated, especially in NAS, and yes, it's a lot of times it'll just do one halfway back, next halfway back, next halfway back. But in a market like NAS that can get really animated, what it does is it hits the first one and it just goes parabolic. So you start taking the highs. Take the high and you'll start to see it's trading to the 50%. Does that make sense to everyone, Leopard? Everybody following me?
Yeah, looks good.
Okay, so we're done the halfway back. And out of options is typing something. Yes, sir.
I was gonna say, don't just listen to me. That I understand that someone else may not. So
You know what options? I mean, you can keep using fib extensions and perpetuity, but sometimes you're going to see them break. So sometimes when you start to see the fib extension break, it'll like just last down, like you don't see a good reaction at the 50%. Then what you can do is you can draw the halfway back again, or like a 50%, because sometimes it will come down and it'll go down, and then you're starting from scratch again. I've never really seen more than 2, maximum 3 extensions. Like probably 2 is very extended. Usually the first one trades, and after the first one, they get riskier. The numbers are just these 3 here, a hill doggo. Very simple. It's like high, low, 50%, and negative 0.236. That's it. There's nothing more.
So essentially, this is just it gives you another target, especially especially here at all time highs. The 236 is just another. It just makes a good target after like if we take all time highs and we keep going, it gives you another good target of drawing that previous range to then look to sell your position.
That makes sense. And I might want to show you guys something else here if I can get it open. I'll finish the presentation and then I'll show you. So there we go. Spicy's typing something, but the next one's the Asian range. So all of you can get your screenshot here. Well, Spicy, go ahead if you have a question. No. So there's the Asian range. I've shown this in many of our streams, so you're probably all familiar with it. This is how I do it. I know a lot of people like to skip deviations, but it's very simplistic. The model is, oh, thanks, Leopard. The model is basically 8 p.m. to midnight, and I've had discussions with some of you about this. How do you qualify whether an Asian range is a good Asian range? And it's not always going to be perfect, but what I like to see, and here's the first Asian range that I've picked, is that there's sensitivity on equilibrium and we have a range. It's not just a big move, but the big moves can work too when you have the sensitivity on equilibrium. So with this day, you see we kind of consolidate in Asia, consolidate. Then we do a Judas up here to 1.5 deviations. And I know everyone has their 2.5, 1.5. I just look for a reversal at one of these levels. I don't care if it's 1.5, 1.5, 5.5. When I start to see the reversal down, especially on the Judas side, you'll see it can violently move down, and you see, like, look at these middle levels. I mean, you have the bodies respecting the 0.5, then you come down here, you have this retracement up to 2.5. You hammer down, you have the body here, hammer down, body here, come all the way down pretty much to 5, but this is actually 4 deviations because this one starts at 1.5. So essentially the Asian range should map out the daily move where it happens. And what you're going to see sometimes is you may even see closes below the Asian range. And another tidbit I'm going to give you guys is when you see that, if you look at ES and you look at YM and they're not closing below the Asian range, the Asian range is still qualified that it's going to go up, because a lot of people have this mentality that if we take both sides of the Asian range before New York, we're going to be in a choppy day. But sometimes you might see that done with one but not the other, and there's a divergence, and the Asian range is still valid. So there's one example of the Asian range. And here's another example of the Asian range. Same thing. Like this one was less of a consolidation and more of a move up, but still you can see there's equilibrium being respected. Move up 1.5 standard deviations, and then we move down 2.5, which is, I know, everyone's favorite number. 2.5 does happen a lot, and I'm sure Hildago will say that in some of the others. So it's certainly a nice target to go for. And do remember, these things aren't always perfect. So sometimes what you might see is you won't get all the way down there, and that could be due to a number of reasons, like maybe there's a little range here or something, but it gets close enough, as ICT likes to say, for government work. Opening balance, I put up my fib settings there. You can do any fibs you want. It's just half deviations, and it's the same thing. It's from a 9:30 to 10:30, and it's very good in a trend day. So the opening balance is something that you would most likely use in a very strong trend day. And I'm going to use the example of the day we had on Monday, because the Asian range just couldn't cover it. It was too, like, you have to get into the opening balance, because back in 2000 and 2001, where pretty much like every second day was a trend day, I mean, I survived on an opening balance. It was amazing. Like, it really is. How many deviations does it go? Could go 0.5, it could go 1, depending on how big it is. It could go up to 5. You just keep on, keep on watching it, and it's going to also react at those different levels. You can put the 236 in there sometimes. You don't have to. Just go at half deviations. So here's the example from Monday. I mean, you look at the opening balance. We kind of moved up. We moved up. Bang, we hit that level here, and then we reacted down. Came back up, tested it, and that was it. That was exactly 3.5 deviations of the opening balance, which is, again, the 9:30 to 10:30 range. I want to go back to the Asian range because there's something I forgot to mention. On the Asian range, although we go between 8 p.m. and midnight, do not include the midnight candle in your Asian range. Do it at there's a 15-minute, but whatever time frame you use, do it on the last candle before midnight to calculate your Asian range. So
So glad you said that. I was literally going to interrupt you in a second and go back and tell people that, because a lot of people put the midnight and then your times will be off. So
it's from 8 p.m. to 11:59 and 59 seconds. But then the opening balance is the same thing. Like, you don't include the 10:30 candle. You have 9:30, 10, 10:15 to 10:30. It's these 4 candles. Do not include this last candle in your opening balance, because it's the first hour of trading from the New York Open. I think I got another example of the opening balance here. This was from the 11th of June. So what you'll see here is 1, 2, 3, 4. You notice I don't 9:30, 10, 10, 10:15. I don't include this candle. What you'll see here, that's why the reason I chose this range is that you'll see here it kind of it misses, it comes short, but right at 3:45 shoots up and gets to that 1.5 deviation point. You'll see that a lot in the last 15 minutes of trading when you kind of come close to one of these levels. So opening balance, again, reserve it for good, strong trend days. It can work in choppy days with a bit of a move and a Judas, but my favorite to use it is on trend days, because it'll probably override, it'll override the Asian range, and it's especially good when you get like an opening balance that's kind of like a range, because sometimes you'll have opening balances where there's like kind of candles and it's not so good, but it still works. And and you also look at the levels, look at the support you got here, look at the support you have here. Same thing here. I mean, this one wasn't as good because there's such an animated trend, but we had resistance, we moved up. This one was amazing. Like, you could have bought here, you could have bought here. If you have a confluence, FEG, opening balance level, I mean, it's incredible. So that's the opening balance. It's the same in the Asian range, which I think you guys are probably masters of, so I don't want to go extend that. Swing projections. Well, swing is basically a Judas. I'm going to use 1 minute swings because I like them. And you can also see a lot more of what's going on in the swing. And also with the swing projections, there's a lot of detail to it that I might cover in another course, because there are certain things that happen at different levels, but a lot of people target the 2.5 level, and some people say if it closes below, go to the 4 level. But the crux of a swing projection is that it's the Judas swing before any type of a move. Like in a lot of the key Judas swing times, like 130, 930, look for them there. And you should get 1 to 1.5 deviations. It's just a low-hanging fruit target. So here's an example on the 1 minute. Right around 930, we had the Judas up here, and it traded down 1.5. Bang! You target the 224. You would watch the reaction at each of these. You can see it. There's no slowing down here. Like, you're not seeing any red candles being broken. No red candles being broken. That's what you do. And you don't see a red candle being broken until here. So 1.5 is a very common target for that. So there's one part. There's another one. Again, around 930, boom, comes up, swings down. This one was a little bit to 1.5. You could have gotten out here, but I mean, it can extend and go down to 2.5. You probably could have done another one from here to here, and that would have given you this measurement. So what you'll see, and this is fractal in time, when 30 seconds and 5 minutes and hourly and daily, is that, what I like to use swing projections. It's not like I'll do it for like a whole session, like the opening balance or like the Asian range. I'll do it for like the individual swings. So if I see like an animated move, and I'm not, I don't have a long-term target or anything like that, and I'm not looking to trade the session, but just the move. I mean, it can work for the session. I'll or I'm not sure where the session's going, and I'll see this kind of displacement here. I'll target like 1 to 1.5. I'd probably be out here. I would hold it until I start to see these green candles forming, and then, you could hold it, and as soon as you see an open above one of these down candles, you'd get the hell out. So that's basically swing projections. Any questions there? Going quickly, which is good. When doing projections, are there any clues price will move to the next deviation? Yeah, I mean, what I would like to you look here, options, right? So here's a swing projection. You react off here, it probably trades up to 50%. So you could have gotten out here if you wanted to at the first projection, because that's that. But then once you go through this level, you'll see there's no red candles that are being closed above, none on the 1 minute. So you could just trail your stop with every red candle down to this level. Have your stop here, come here. We've hit the 3.5. Then as soon as it breaks it, you're out. Or you could just target the 1.5. This one's a little trickier, but this one you kind of follow the order flow. You have FEGs that aren't being broken. FEG here goes down. FEG here, that's not broken. FEG here, that's not broken. Then this FEG closes above. You get up there. I mean, it's like anything, but I think these give you a general gist of where it's going. I mean, if I could pull these levels, I could also just do a halfway back here and see how we're going. I bet you this is the negative 23.6. Well, we can actually look at that after I'm done, because I have the date here. It was the 13th. So maybe when I'm done the slide presentation, I can get into some of these in TradingView and show you. Because what you'll do is you can combine. Like, another good thing is to take all these different methodologies and look for confluences between them. So you might see an Asian range level that ties to a swing projection, that ties to opening balance deviations. The more of them that are lined up and there's a PD array, the stronger they are. All right, so this is the deep area, and ICT, like his main model, and he's always said, is the market maker. But if the market maker is not clear, the thing he does is he grades the swings. And what he does is he has a drawn liquidity. He sees where the swing starts, and then he measures it up to where it's going and grades it into 4 quadrants. I'm going to use the example of Monday because the drawn liquidity, which I stated in our stream on Monday, is very clear. It was 20,000. So, you could assume here it is. So this was last Monday. The grade on the U contract was 20,000. I could have drawn a fib here, even like, assuming you can't see any of this stuff. Like, you can't see anything here. As soon as I see this, I know we're probably going to go here. So I grade the swing. What you'll see in a graded swing with 4 quadrants. The top of the first quadrant is where you're going to see the breakaway gap form. Right up into equilibrium or below, you're going to see the measuring gap. And in the third quadrant, this is where you don't want to be buying, because I mean, you can chase, but you're not going to get retracements. It's going to be very animated. You should have all your pyramiding and positions done, and where it goes up to here. Also, what you'll see on this top quadrant is this a lot of times will be where the turnaround will happen. So this will actually be, this quadrant can actually turn out to be where the reversal will happen, where you could have like an inverse or a breaker or something. The top quadrant will give you resistance going back down to do the other side. There's a lot more to this, and you can grade these into halves, but that's the general gist of it. And in every swing, they always have the same things. Like, you're not going to see the breakaway gap, and you're not going to see the measuring gap in every single time frame. So you have to kind of cycle, because I'm going to show you the 1 minute later on, and you're not going to see those things. But the next question is, everyone sees these fancy names, measuring gaps, and like breakaway gap, we all know. But do any of you know what a measuring gap is? I'm going to ask that question before I go to the next slide. We all know the term measuring gap. A lot of us know that it happens around the or below the center of the dealing range. No, well, there's actually a way to measure a measuring gap. So I'm going to show you this, and this is something that a lot of people don't know. I know Leopard loves my heading here, but really it pissed me off because like everyone's talking about this. No one knows what is a measuring gap. If you draw your swing from the low to the low of the measuring gap, look where it goes. You can actually measure, you can actually do a measurement. And if that measurement has a confluence with where your drawn liquidity is, there's a very strong chance we're going there. So this is a new concept. This is not a concept that even ICT talks about, and that's why you don't see it on YouTube much. But it's basically drawing the swing from the swing low to the low of the measuring gap and then doing deviations up. Is that clear? So that's what a measuring gap is. That's why it's called a measuring gap, because you can actually measure it.
So you are, this is new. This is new, pretty new to me too. So it's basically drawing the first swing of the news, like that first swing, and then up to the first FEG that's formed above that swing.
No.
Oh, let's see
So
that. That's why I asked.
so the measuring, okay, so first thing you got to do is you got to look at the whole swing. So let's say you can't see at this price. You got to have a pretty, like if you have a good idea like 20,000 where the drawn liquidity is, you grade the swing. Then you see at the first quadrant is a breakaway back gap. Second quadrant, like in the equilibrium, at or directly below that, you're going to have a measuring gap. So you've qualified this as your measuring gap, okay? It's not just any gap, it's the measuring gap. And the measuring gap occurs at, around, or below, or just below equilibrium, okay? That makes sense, Leopard? So it's not just any gap. And then what you do is you measure from the swing low to the low of the measuring gap, which I'm doing here.
That's more
That's a
clear.
measuring gap because it was below equilibrium. That's not just any gap. If you did it to that gap, you'd get wrecked. You have to make sure you're using the measuring gap. And to find a measuring gap, we're going to go over this example in the charts so I can show you all. And what you'll see is like on the 1 minute, you don't see, there's no breakaway gap here. There's no measuring gap here. So you have to cycle timeframes. Well, I knew, no, well, yeah, those were confluences for the draw. Absolutely, CD. But I knew that 20 was a big draw. And then when I saw the breakaway gap and I saw the measuring gap, I was pretty sure we're going to go there because I saw the gap below the equilibrium. And when I saw this, like a breakaway gap in the first quadrant and a measuring gap here, that gave me a pretty damn good idea that the only issue there is that equilibrium could be a little lower, but I knew that because of the contracts, I had a really strong confidence level in that draw. Your draws aren't always going to be perfect. Well, but what you do is you draw from the low of the swing plow to where your drawn liquidity is. So you would know it was a measuring gap. Probably up here when these candles are closing, you would say, okay, we're above equilibrium, we're moving up, and the measuring gap's here. So you draw from here to here, knowing your drawn liquidity is somewhere around here, and you're using the measuring gap to confirm your drawn liquidity. Right? You can't just measure a measuring gap and randomly look at like trying to find a standard deviation. You want to see the confluence of all these measurements with where you see the drawn liquidity. And this drawn liquidity, sometimes it's going to be a daily FEG, and sometimes it's going to be a very high, like higher time frame liquidity pool. In this case, it was the 20,000. We knew that the contract was trying to get the 20,000. But another great thing about grading is that look where your setups are occurring here. So the first grade is usually a really good place to look for entries. Look, I mean, there's a lot of entries here. The next entry is usually at equilibrium. Then we start to accelerate up. You have a little order block here. This is where it starts to get animated. You kind of see where price was now, is right actually in the middle of this top quadrant. But you'll see like a lot of great entries are at the, you see confluence between a PD array and one of these quadrants. They're golden. This one we never actually retraced into, but you have an order. You have these order blocks here. We kind of came above and displaced. You can buy that. This one you actually got right into there. Um, does that make sense to everybody?
Yeah, so kind of what CD just said. So say we have equal highs, like hourly equal highs, maybe like 100 points up, and we're 50 points, and we've already covered 50 points towards them, just using basic math here. And so like if we start displacing and like going through 50%, like that would just confirm that your bias is correct. Is that what you're kind of getting at?
Yeah, I mean, but if I found a gap below 50% and we displaced through it, yes. And
Okay,
as well, you could I would just like, you have to believe in your DOL.
right.
But what I would do is like the biggest takeaway, I wouldn't start working too much with measuring gaps because it's pretty detailed. I would just look at the 1 minute and lower time frames, draw your graded swing, and look for entries around the 75 and 50 point. And even you could even look up here for entries. Like you have the order block you came above. You're going to
Yep.
see a lot of where do entries form and where are high probability FEGs at these levels.
Yep.
I mean, this can go deeper and you can break these levels in half and even, I mean, we'll go to the charts and I'll show you guys. I think we can go through this on a chart, but this is something like the measuring gap ICT doesn't talk about much, but it's a very important gap and it's measurable. And
Okay.
there's actually it actually can measure the swing. What you can do is you can actually grade a range. You can actually do a graded range inside of one of those massive weekly or daily fibs, and you'll see that's the range you're working with, and you can actually work these levels even when you've traded them. That'll be your dealing range. Like a dealing range will be inside of a daily fair value gap, um, a very large one or a monthly. You could do that. You could actually break it up into 8 sometimes. So does that make sense? Like this is the end of this presentation, but I'm gonna show you this in the charts.
Yeah, you're just saying just look for entries below 50% of where your projected draw is.
I would take entries even above 50%
Yeah.
if I'm very confident in a draw. I'd look at the third range. I would take, this was such a strong trend. You could have taken entries anywhere, but
Yeah.
the highest probability entries are here, here, and once you blast through this. But when you get past here, this is where it's going to really accelerate.
Okay.
Like if you broke this in half, you'll see from like the middle of here to the top, it just kind of went straight up almost.
Gotcha.
Um, so hopefully that helps. Like I think now we can go to trading view. And is everybody, all right, let me just move you over. Okay, so can you all see my chart here? Because I'm going to just go into the,
You have to reshare your screen, I think, Mark.
oh, do I?
Yeah.
All right, just give me 1 second because I have to fix something here anyway. Just give me 30 seconds while I set this up.
Anybody else have any questions while we're waiting on Mark?
Stupid, like, okay, here we go. Let me just get this up and running. All right, I'm going to share my chart. Yeah, Mass, you got to be confident in the bias and
Yeah.
like anything else. So here was the range that we graded. So let's just look at this. Imagine we're here. Okay, imagine I'm here. I'm saying, okay, we're starting to displace here after this candle. I want to do a fib from here all the way to 20,000. Oh, wrong. Sorry. Let me just go to the NQM. Can't really do that on NQU. So I want to go from here to 20,000. Bear with me while I figure it out. I want to make sure
I never knew you could change the time the price levels that way.
Yeah. So here we go. So like all of a sudden, I say, okay, here's the low. This is the drawn liquidity. This is my graded fib, and we're just trading along on the 15-minute, and I see this. So we've basically gone through the equilibrium. Here's a measuring gap. So what I want to do my measuring gap. Do some opening balance deviations. Look at that confluence there, right there. That makes sense. That's before we've even gotten there. I've graded the swing based on what I see as my draw and liquidity. We could even take this down to there's a 15-minute. We can go to the 5. We can actually go to the 1 minute. We do that. I wouldn't do it until I start seeing this displacement here, just so you guys know. So we displaced. I see the displacement above that 7.5 level, and I see boom. I mean, this is really like fortune telling, but you can do this with other ranges that have already formed. Look at that. You could even set your target to the midpoint of the range, but you see this? Look how we went through equilibrium. So now I know it's very unlikely that price is going to displace below that equilibrium until it gets to its target. So I want to buy when I have a chance. And then if what I can do is I'll actually show you what it looks like if I actually grade it into, I'm grading it into half swings too. So I'll show you guys what happens in the last, look at the last quadrant. You get this and you just whip right in there. But these are quadrants too. You can look at it on a 5-minute too. So you don't really get the same clarity with the gaps that you get on the 15-minute, 1 hour. I guess you could use that as a measuring gap too. I don't know if it'll work as cleanly as a 15. I always use the 15 if I can. Yeah, it does. Boom. Same thing as on the 1 hour. So does that make sense? Like, it's a real, and that's what ICT does. Like when he doesn't have his market maker model, he basically does that. He grades the swings and looks for entries around here. He looks for entries around here. There was another slide that I wanted to look at with you guys where we actually looked at, just bear with me, I'm gonna pull up that slide right now because I want to find that and go over that with you with an NQU. And let me know if I'm too much detail here.
Can never have too much detail, Mark.
I think it was inside of this one somewhere. It'll be no, it'll be recorded. So you just go through the recording. I'm not going to share the slides just because this is stuff that's not in public domain, and I'd like to keep it among us. Too good for the masses. So this is what's the date, the 14th at 6 a.m. Among Us. You're playing video games now, pal? Okay, pal wants to get to Among Us, so let me just get this done. So this is where I used some of the halfway back example here, the 14th at 6 a.m. Okay, so we have this swing here, traded, and then what I think I had an extension from here. Traded, and then what happened is it broke down. So I was showing options, like when the extension breaks down here, this extension to here traded, but then we just broke down. When you see that breakdown, then what you do is you look at the next halfway back. And that actually dug pretty deep. So preset on your trading view. What?
He's asking you, so you have all these different fibs saved as templates on your,
These are all
yeah,
my fibs.
yeah.
Like I got a lot of fibs. Like every time I find something new, I crank them out. But I mean, this is a dealing range here. So here's a dealing range. You can actually grade this range. And look here. So this low to this high, this took a low, this took a high. You got some, you'll see around here, you see it go down, hit the equilibrium, come back up, almost reach the low of the first grade. I know this is a little wishy-washy, but you can see how it moves between these grades. I was actually watching that. I was actually watching that on our last trading day. This day here. If you look here, we had that big retracement. Look where it went. It went right to the first grade. Traded in here, kind of moved along here, consolidated. I think I've showed you guys in the consolidations how it works. I'll show you again. But if you take it into like consolidations, this will be a little bit extra if you guys want to stay. I mean, I don't want to interrupt Plyo's gaming.
Uh,
Sorry, Plyo, I can't resist. So what you do here when you do it, when you're in a range, and I've shown some of you, but some of you might not have seen it or not been around. You only want to take trades in the top and the bottom grades. Extreme premium and extreme discount. And for grading, the guy who really covers it well, like and is very articulate, and I'm going to recommend him because I know him. He was ICT charter. Is a guy by the name of Ali Khan, Khanict, and his dealing range theory videos are phenomenal, and they really talk about the stuff. Like I'm teaching it here. I know it, but I can't say I'm the best at explaining it. I would strongly recommend to watch his DRT videos because that will show you how these grades work and how the where the breakaway gaps are, where the measuring gaps are. He doesn't show you how to use a measuring gap. No one does. Like you're not going to see that anywhere. So please try not to share it with everybody. I mean, I'm not going to stop you, but like it's like something that very few people outside of the ICT mentorship know. But Ali will go over that, and a lot of people also don't say with this stuff that you can actually do it based on your projected swing, not just on the past dealing range. A lot of these guys are going to show you the past dealing ranges, but they're not going to show you the projected swings. So if I look for a dealing range here, like we have one right here, this took out a low, took out a high. There's our dealing range. Oops, pretty bad draw. See, like you got the discount premium comes back up here, comes back in, but once you break out of the range, a lot of times it'll just come to the third grade and then take off. The market's very animated. I mean, there's so many different ways to skin this cat with trading. You know, I would suggest you guys don't look at everything I'm teaching and try and figure and master it all. I don't even use most of the stuff. I understand it, but if I were sitting there using all the stuff, I'd never make any money because I would like be so busy trying to like figure doing all my different measurements and everything that by the time I figured out what was going on, the trade would have passed out. But look, take one or two of them and try and confluence them with what you know and what PD arrays you have. I hope that helped. I mean, I think I've covered a lot of what I wanted to cover, and I want to make sure if anyone has any questions, I'm happy to help you and explain those questions. But really, the simple breakdown is the opening balance and the Asian range are just ranges. They're timed ranges that you use, and you make deviations. Halfway back just gives you a very low-hanging fruit. When you see a very animated um, reaction from a 50%, you can reasonably assume it's going to get up to the 23.6. But it's not always going to work, and it's going to fail sometimes, like here. If you look here, there's no halfway back here. Oh, actually, I take that back. Look at that. It actually did work. Pretty much. Like I missed it by a tick. There you go. But normally I would just target the high under these circumstances because you're in a consolidating rangy day. But we could go down to the 1 minute and see. Yeah, exactly. You just keep these in mind, and if there's something that resonates with you that you see easily and you want another confluence, do that. Like these are really confluences. I love measuring because I like the precision of it. There's no ifs, ands, and buts around it. I'm just going to see if I can find some halfway backs in here. There you go. There's one. Boom. So that's around lunchtime. Comes back, you get the response, consolidates around the high, and then goes up and takes the 23.6. If you go into the daily, especially on ES, ES is amazing for halfway backs. Probably better than NASDAQ because NASDAQ gets a little too excited. Oh, this is the one I wanted to look at. So this is where I think our extensions failed around here. We have our extension here to that. Anyway, I mean, there's a lot of halfway backs you'll see trade in here. That didn't even make it back. See, like if you're trying to do a 50% like everybody else, you're going to be fucked. Like on NASDAQ. NASDAQ is an extension indice. It's very highlighted. So you're sitting here waiting for the 50%, like, oh, I'm gonna, you're totally fucked. I mean, whereas if you actually understand how to draw an extension, look at that. Like you got an entry right there. You can see. Look at how it comes up, comes back to that exact level, and boom, off she goes. The low on that candle, 86.25, 86. You missed it by a tick. So I strongly recommend in NASDAQ. I'm going to go to ES here because I think ES actually loves halfway backs. That's where I learned them originally. And that wasn't an halfway back is not an ICT thing, by the way. That I learned from other places. So here we have a halfway back, boom, boom. This one, the extension actually failed. You can see that's why it's better on Nasdaq, because if you drew the extension here from the high, totally failed. But what you'll see is that back to this low, boom. Look at that. So you go here, here, into the low. Where does it go? Right to the halfway back. Then we have a retracement and then up. This one's a weird one because it actually didn't retrace back to 50%. It took off. So because that didn't happen, you could try an extension here. I'm not sure if it'll work or not. With ES, I would do it only on NAS. There's your extension right there. Boom, halfway back. See that? So yeah, we had a little bit of a push down here, but this push down, because this push down didn't go to 50%, you see that? It was still animated and it kept shooting up. Then you can actually draw from the high. I don't know what the hell. Get rid of this. So then you can draw from the high up to here, literally target that, boom. I use these a lot of times for long-term projections, just to get an idea of where price will go, like I've shown Leopard. So that's the presentation. Put it up for one last round of questions, and then, it's not even an hour of everybody's time, and we can all go back to our weekend. Any other questions or Leopard?
I will say this is basic drawing fibs. Just make sure I've seen it. We've seen it we've seen it a few times. Make sure when you're drawing that your zero starts your range and not the one. So just make sure you are drawing it correctly, because otherwise you're going to be looking at like this first standard deviation. You're going to be looking at the second deviation that you think it is, but it's actually going to be the first deviation. So just
You're saying
ensure,
with like the ranges, like the Asian
yeah,
range
like
fibs?
make sure your zero is on top there. If you're looking for 2.5 standards deviations up, like sometimes it's like it's just something that's like, I guess
Yeah, like if you
you
reverse it, it gets messy.
yeah, you just draw it and yeah.
If you draw it in the direction that you're supposed to go, it should work.
Yeah.
But I mean, like, there's a total failure. Like, anyhow, how would I get that? Who would get that confused? Some people.
Hidalgo was making a jab at himself, but I wasn't gonna name drop.
So that's the story. Have a great weekend. Any final questions? It was shorter than I thought it would be, which is good. I mean, these concepts are very like straightforward. If you have any questions, you can always DM me. But these are good things. Like, I mean, you don't even have to measure the measuring gap. You can just kind of draw your swing projection and look for 1 minute setups around the 0.25 and zero point 0.5. And if you see a big gap below the zero point 0.5 and it moves up, or a big gap at the 0.25, you know that your draw is probably accurate. Anyhow, so that's the story. Great weekend.